Doomscrolling, aka the activity of scrolling through social media for hours on end, has now become quite a common addiction amongst everyone. Unfortunately, like almost every addiction that exists, it's a problematic one. And worst of all, these social medias are all designed and engineered to be that way. Their one common goal is to keep you hooked on their app for as long as possible. This is done through various methods such as using algorithms to show you more videos that you like, social validation by providing them feedback and recognition for their activity that activates their dopamine receptors and boosting their ego, and so on. But what if you could capitalize off of them, even while still being able to doomscroll yourself? Well, in this video, I'll be showing you a proven trading strategy that prominently depends on your ability to doomscroll, pattern and trend recognition, and ability to connect the dots. This strategy is called social arbitrage trading, and it relies on, as the name suggests, an information arbitrage. What is social arbitrage? So before we get started, what is social arbitrage trading? In short, this strategy uses personal associations and conversations to spot social trends before others have noticed. Okay, how are we able to trade off of that and make money? You see, the market consists of market participants, which consists of humans and algos. The majority of market participants and the ones who have the most influence are the humans, more specifically the investors with the big bucks. And these investors are driven from a multitude of factors and analysis, most traditionally being fundamental. So now that we know that humans hold a significant power and influence over the market, we can use this knowledge by observing noticeable trends and patterns within people and trade based off of it. A social trend can sway market prices because they influence investors, which holds a significant power. To put it simply, imagine if there was news that a customer was served a deep fried rat in their meal from McDonald's and it went viral. It doesn't take much to connect the dots to figure out what will happen to McDonald's stock prices. As you may have guessed, it's going to most likely drop because of the negative sentiment surrounding the company, which scares off investors and pulling out their investments.
Give me my fucking money back.
Now, that example is extremely oversimplified, and there are many factors that need to be considered before even thinking of trading it. Social arbitrage relies on an information arbitrage, which means that there exists some form of information that hasn't yet been picked up by the markets and other people, which you can capitalize from. So that means you have to be ahead of most people to realize an actual, feasible opportunity, which leads back to the point of doomscrolling. Social medias and other platforms allows the instantaneous connection of everyone globally. You can use this as your advantage while most people doomscroll relentlessly without gaining anything much from it. I've created a 3-step process in this video which you can use to gain insight from your doomscrolling and turn it into potential profit. But bear in mind, I'm not a financial advisor and none of this is financial advice. I feel like that has to be obvious enough. During your doomscrolling journey, this step requires you to gather insight from any potential social trends that relates to a particular company or organization. To improve this step even further, you can scour through every public and open source intelligence for social trends, cues, hypes, rumors, and so on. An example of a trend is a viral sensation, boycotting, word-of-mouth marketing campaigns, and so on. Since we do not have access to high-level information from companies or government organizations, we shouldn't focus too much on them but use them as verification methods, which brings us to step number 2, verification. Once you have identified a social trend, you have to verify if its existence has an influence on the company or organization in the first place. Compare the sentiment and information across different platforms and sources to identify discrepancies or divergences. Look for situations where sentiment or information differs significantly between platforms, which could indicate mispricing or trading opportunities. You need to monitor people's comments, trends, and sentiment surrounding anything related to the assets or markets. After that, you can employ sentiment analysis tools and techniques to gauge the overall sentiment expressed in social media discussions and news articles. Sentiment analysis algorithms can help quantify whether sentiment is positive, negative, or neutral, and track changes over time. Use tools like search engine trends, keyword searching, and look out for virality and popularity. Refrain from using the conventional sentiment analysis tools which most traders use, because once they caught wind of it, it is already too late and it has most likely been priced in. A way to verify the relation of a social trend to a particular company or organization is to look at their relationship with a regular common folk. How would they be impacted if people are being influenced by this trend? What if it becomes a meme or a viral sensation? Once they get picked up by the news or media, how will it affect them? Does it sway the amount of demand of their products or services? Will it bring fear or joy if the investors and shareholders hear about it? Little bits like these can help verify the existence and worth of a social trend. The hard part is determining if the trend is going to continue growing and becoming widespread. You have to keep in mind that predicting social trends with 100% accuracy is impossible, well, unless you use unethical or illegal tactics like market manipulation, which we're definitely not doing. The idea is simple, but it is not easy. In order to have an information arbitrage, that would mean that you have to figure out something and connect the dots way ahead of the majority. In order to do that, then you'd have to keep the reconnaissance step in mind while doomscrolling, which not many people are even aware of.
Yeah, I came in with the saw. Ooh, yeah, I came in with the saw. Bitch, I play red raw. Yeah, bitch, I play red raw.
Finally, we have the final step, which is just executing our trades. After all the information gathering and verification that you've done, all that's left to do is to execute the proper trades from your analysis. Make sure you don't get the idea and the simple part wrong, because people still tend to do these mistakes. I guess common sense isn't so common anymore. Anyways, make sure you have a concrete cause and effect proposition. If X happens, then Y will happen. If X doesn't happen, then Z will happen, and so on. This is where you should also analyze your verification and make it make sense. In simple terms, all you are doing is figure out the path and execute if the water is going to flow down that path. It doesn't matter how it's going to flow, all that matters is if it has the same objective value. And to figure out if it's going to flow down that path, you have to notice change. And don't take it from me, take it from this guy who uses this strategy and turned 20 grand to 42 million.
Now, when I use the word change, what I mean is any change that's happening in the world that has the potential to positively or negatively impact a company's performance. Any type of change that has the capacity to impact economies, financial markets, market segments, or individual companies provides an opportunity to profit as a trader.
These so-called changes are potential catalysts that propel these social trends to a bigger scale. You might have some skepticism of the validity of this strategy, and I don't blame you. But I will give you two answers on why this should work. One, the guys with the big bucks don't spend their time doomscrolling, so they are more than likely to be behind of certain social trends happening in social media. The time you have doomscrolling gives you an advantage. Two, it isn't that quantifiable or easy to be coded to an algorithm, which most of the market participants rely on. Almost every trade that happens nowadays are executed by algos who rely on mathematical models or machine learning. So you'd have plenty of opportunity since your competition are bots that relies on numbers instead of intuition. I'm not a preacher and I don't like preaching what I don't practice. This is why I have now incorporated sentiment analysis in my trades and became less reliant on technical analysis. I'm also not saying that this is the best strategy or system for trading out there. There are many that also works. This is just one of them that I think works best for conventional retail traders like you and me out there, in my opinion, but don't take any of this as financial advice. Please do your own research. I'm not a financial advisor, I'm just a guy making content on things I've learned. You might have gotten some value out of this video, or maybe not. Who am I to judge? But hey, some feedback and constructive criticism would be appreciated. Like this video if you enjoyed it and subscribe if you want more of my content. Thanks.